S&P 500 and NASDAQ both trying to claw back some of this week's losses after new benign inflation data, but still on track for their first back-to-back weekly decline since April. Joining me now is Nick Colas, co-founder of DataTrek Research. To weigh in, Nick, good to see you. I know you've been, pretty much favorably disposed toward the market most of this year. I think you probably figure this choppy period will resolve somewhat higher. But how does it look right now in terms of, tactical? Sometimes you get these fits and starts once a pullback's been initiated.
Yep, totally true. We've been positive all year, but however, we do see some volatility coming up, some more volatility coming up. Look, we've had a great run in the first half. July's proven choppy, and it's pretty clear that we've got to resolve this imbalance between very large cap tech's valuations and the Russell's valuations. The Russell's about $9 trillion. The top three tech names are roughly $9 trillion. The capital is moving from three assets to a whole bunch of others. That's going to take some more time to resolve itself, and volatility will be elevated between now and then. We're looking for a bottom when the VIX hits 19 to 21. That's happened twice in the past 12 months, and the S&P bottomed 4 to 5 days after. So our near-term look is still to the downside.
The VIX did click above 19 yesterday, no?
It did, but you want to see a close. I mean, we look at closing VIX levels. 19.2 and 21.7 were the highs for the VIX over the last year in those two downdrafts, ending in October and ending in April.
And so, I think along the way, as the largest stocks and the ones that were most owned and had the best growth, and, we call them the Magnificent Seven or whatever else, as they dominated this market, there's a lot of stories about why it wasn't a bad thing necessarily. Bull markets take all kinds of forms. These were the best quality companies out there. So do we have to unwind them all the way and have them converge with everything else in valuation, or how much do they have to give back, I guess?
Well, we had a lot of enthusiasm on one particular new technology, generative AI, which is a totally valid investment thesis. But I think we can all agree in retrospect, things got a bit overdone. And the hype behind that trade kind of maxed out at the end of June. And now we're cycling into another kind of trade, which is more cyclical in nature, more of what we would call a mid-cycle market, where industrials outperform, financials outperform, the more classically cyclical parts of the market outperform. And they're playing catch up right now, both because we have a good economy and we're expecting rate cuts, and because markets think there is some level of certainty about the election in November that might favor Republicans. And so we have a classic trade in that direction as well, favoring sectors that would benefit from deregulation. So you put it all together into the pot, stir it up, and you get this market.
I mean, it is certainly mid-cycle or whatever you want to call it until proven otherwise. But one feature of those environments is that you always have anxiety that it's falling away or that there's something that's going to deviate from the expected trend. I mean, right now you see a lot of anecdotal stuff or collective anecdotal stuff sector-wise about weakening consumer. You saw the auto stocks this week, or maybe the unemployment rate is showing a little bit of lift. So how confident are we that if the Fed's cutting, it is going to be into a resilient economy?
Yes, you're right. Mid-cycle markets are just as hard to trade or invest in as any other kind of market. You look back in history and say, oh, the 90s were easy, you made a ton of money, or the mid-2000s were easy, or the 2010s were easy. They weren't easy. We always had things to worry about, and these are exactly the same kind of issues you're coming up with now, which is the consumer okay? Is the Fed going to be able to cut enough? These are constant parts of mid-cycle markets, and until you get a really catalytic event that ends the cycle, like the financial crisis or Iraq invading Kuwait or the 2020 pandemic crisis, until you get a real catalyst, these cycles tend to continue on for years and years and generate very good returns.